Hello and welcome to the Market Masters Trading Podcast, episode number 2, where we're going to cover the U.S. equity markets as they continue the Santa Claus rally from the end of last year. We're going to look at what's to come based on the historical returns from last year, and going to take a look at the small caps as they diverge from the bullish trend of the broader U.S. equity markets. We're also going to take a look at commodities and oil as their bullish rallies from the last month or so have been very well supported and are likely to continue on. My name is Logan Guest. I'll be hosting this podcast indefinitely. Thanks for tuning in this week, and without further ado, let's dive into it. 2021 ended with the S&P 500 returning 28.71% since last year, and the worst drawdown for the S&P 500 was just a little over 5% per the first chart in the accompanying newsletter. The S&P traded to $4,800, with a bullish continuation being the most likely scenario going into this start of the next year. The Santa Claus rally gives price targets in the 4,900 to 4,950 range for the next impulse higher based on technical analysis Fibonacci extensions. We will look to the technology sector for further loss of momentum to see if this has any further influence on the market going forward. In other words, we're looking for sector rotations that would prevent a broader continuation to occur. Now, whenever the market has performed this well, we have seen a continued performance into the end of the following year. And this can be seen in the table provided by Ryan Detrick's tweet that is in the accompanying newsletter. You may notice that this historical data may contrast with the state of the markets that we have outlined in the last week's issue and our first podcast release. And that is precisely why this is such an important thing to consider. History is telling us that we are overdue for a correction, but it's also suggesting quite a few bullish signals, especially when it comes to investor sentiment and technical analysis. A crack-up boom continuation is something to consider. From a macroeconomic and market function perspective, we are well overdue, and this is outlined in our first episode of this podcast. I invite you guys to tune back into that podcast and review that accompanying newsletter because there's a lot of valuable information in that. The Russell 2000 is seeing a divergence from this bullish trend, and we don't have quite enough enthusiasm to muster up a move higher to all-time highs. The Russell 2000 was trading range-bound for the entire year of 2021 and created a prairie dog-like formation on the weekly charts, giving a violent rejection, only coming back down to test the lows from the channel that was formed all year. In other words, there was no follow-through on the breakout, and the sell-off from the breakout put us down to the lows of the year. This is something that we need to continue to watch, especially going into this coming year, as a further breakdown would be significant for the direction of the broader market. Moving on to commodities and oil, we have bullish breakouts in both. The bullish breakout in oil has been very significant. We ended the year with a small pullback, but we continue to view the dips as buying opportunities, headed with macroeconomic factors that are likely to push prices up in the midterm, i.e. the growing demand for energy as the economy throughout the world expands as we exit the pandemic. We're going to be watching for swing lows that develop if the price dips back towards the $73 support on a natural Fibonacci retracement. You can see this as outlined in the newsletter. Gold is now above its one-day moving averages, that being the 9, 21, and 55. The dip was bought, and this week is going to be very telling as to whether this rally is only the beginning or just another dud. We can see the follow-through on this next bullish rally into the $1,860 to $1,900 range, with support at the $1,795 and $1,780 zone. And touching on U.S. Treasury bonds quickly, the U.S. Treasury bonds yields continue to consolidate with really no clear trend emerging yet. This is going to be very telling for the risk-off cycle, or whether or not people are going to rotate into less risky assets. Now, this is a very interesting thing to be watching as well, but I think that the trend for bonds will continue to be less effective at predicting future outcomes, especially as the crypto markets continue to evolve and offer other debt instruments that might replace bonds. So this is something that I think investors need to be aware of, and definitely going to be a theme, especially with decentralized finance becoming more popular into 2022. Now, besides all of this, there's really not much earnings this week that'll be driving the markets. The only two we're going to be looking at are going to be Constellation Brands and Bed Bath & Beyond. So if you want to learn more about that, make sure to tune into the newsletter. I also have a few other links on the newsletter and to a recent YouTube video explaining trade management. So if you guys want to learn more about that, tune into those resources, and I will have a few other resources coming soon. So make sure to follow on other platforms as well. And that does it for this week's podcast. Thanks again for tuning in. These are going to be quick updates about the newsletters every week, and we will continue to get more and more information packed into these episodes, and also going to be working on getting more guests and other speakers in the near future. So if you want more content like this, please do share, consider giving a 5-star review, and give us your honest feedback. We would love to improve things and make sure that the show is giving as much value to the listeners as possible. Thanks again for listening, and we'll see you in the markets on Monday.